Hi everyone, we are now going to look at Chapter 3, Working with Financial Statements. So we'll be looking at standardized financial statements for comparison purposes. We'll compute and, more importantly, interpret some common financial ratios, name the determinants of a firm's profitability, and explain some of the problems and pitfalls in using financial statement analysis. So here's a sample of a balance sheet like we saw in Chapter 2, where we have our assets, current assets, CA, on the left, net fixed assets, and total assets. And this is in your book as well. And it is, sorry, I had to bend over to get my book. It is on page, or is this one on there? Oh, maybe it's not. No, I apologize. It's just a sample on our PowerPoint here. Make sure. Yeah, there's Profrock Corporation. Okay, but just to remind us about how assets are now, remember, categorized between current and fixed. And on the right side, we have our current liabilities and long-term liabilities. And then we just have common stock here, but there would also be the retained earnings component. Assets equal liabilities and equity. Here's an income statement. Again, we're reporting revenue, subtracting cost of goods sold, expenses, depreciation to get our earnings before interest and taxes. Then we subtract our interest expense to get taxable income, compute our taxes, subtract those to get net income. Remember, our income could either be paid as dividends or held as retained earnings. And then we have this other thing called earnings per share, which we'll talk about. Okay, so we use the balance sheet and income statement to create cash flow. Now, you've seen a cash flow statement in Accounting 112. So with cash, we're always looking for the sources and the uses of cash. So cash inflow occurs when we, quote, sell something. So when cash is coming in. So hey, we're selling something or not paying for something. So if an asset like accounts receivable or inventory or net fixed assets decrease from the beginning of the year to the end of the year, okay, so they decrease. We have less of those assets. That means we spent less in cash on those assets. So there's more cash. If accounts receivables decreases from the beginning of the year to the end of the year, we collected more in cash net during the year. But if inventory decreases, we bought less. Same with fixed assets. An increase in liability or equity account also signifies more cash in the company. So if a liability increases, so it goes from $10,000 to $20,000, the difference, we spent less in cash. We borrowed more. So that means our cash increases. If our common stock increases, our cash increases as well. We sold more common stock. So when we're determining sources of cash, where we're getting the cash from, we're looking to see what happened to our assets. If they decreased, then our cash increased. What happened to our liabilities? If our liabilities increased, so did our cash. Cash outflows occurs when we buy something. So an increase in an asset means you're buying more of an asset during the year. Cash decreases. If the liability decreases, that means you paid more off of a liability or an equity account. So that's a use of cash. So that's how we determine cash inflow and cash outflow, sources and uses. So our statement of cash flow summarizes these sources and uses of cash. It's a financial statement. And it does it by three major categories. Cash sources and uses from operating activities, sources and uses from investing activities, and sources and uses from financing activity. So what are we looking at here? Well, operating activities, what we're doing is saying, okay, what's our starting point for our operations? It's net income. But net income from our financial statement, remember, is not a cash income, it's an accrual basis income. So we try to determine or change the net income from accrual to net income from cash. And the way we achieve that is by taking the change in our current assets and current liabilities and adjusting net income for them. Okay, if you turn to page 53, there is a statement of cash flow for Prufrock Corporation. So let's take a look at this before we keep going to the next one. Top of the page, we started with the company's net income. Now, Prufrock's net income is $435. Okay, they start actually with the beginning of the year's cash balance, and that's fine. We put it down at the bottom, but it's fine if it's at the top. So we're saying, here's where cash started. Here's how cash changed from operating activities. 435 is net income. We then add back the depreciation we deducted because we're trying to convert net income from accrual basis to cash basis. So if we're trying to determine net income from cash basis, we should have never subtracted out depreciation expense because it has nothing to do with cash. So add it back. So the 276 is added back. Now we go to our balance sheet and we start looking at how our current assets changed from the beginning of the year to the end of the year. So if you go to page 51, we say, did accounts receivable increase or decrease during the year? Well, it increased. So that means we collected less in cash. So the effect is a decrease. You see down below it says less, increase in accounts receivable. Yeah, accounts receivables increased, but the impact on cash is to decrease it. Same with inventory. It went from 393 to 422, so we bought more inventory. So that means there's a decrease in cash. Now go to your liabilities. Accounts payable goes from 312 to 344. Now that's a liability increasing. If a liability increases, we spent less in cash, so that's actually increases cash, and you could see the positive 32. Notes payable are not accounted for here, even if they're a current liability. Okay, they're not accounted for in the operating because loans are never considered part of operations. So we look at how current assets and current liabilities, except for notes payable, changed from the beginning of the year to the end of the year. And that change, the impact on cash, will then alter or change our net income to net cash flow. So what that would do is we take net income, we add back depreciation, we increase the net income to convert it to cash, 32, decrease it for the increase in accounts receivable and the increase in inventory. So overall, if we reported income when we collected cash and spent money, our net income would have been 691. So that's the cash or the source of cash from operating activities. Now the next major component of our cash flow statement is investing area. And this is where we account for the sources and uses of cash from our fixed assets. That's it. Because that's where our investments in our company are. Intangible assets and tangible assets. So we go back to our balance sheet and we say, how did fixed assets change? They went from 2731 to 2880. Okay. Now, if you go, well, they increased 149. Okay, but if you come back, it says minus 425. Here's what you have to remember. The beginning of the year, the balance in our fixed assets was 2731. We decreased that for the depreciation this year. So subtract it, 276. So really, the net fixed assets are 2455 for the year. So if we bought no assets, that would have been the balance at the end of 2018. No, the balance at the end of 2018 is 2880. So now minus 2880, and you get 425. So what this is saying is the company actually purchased and spent cash on $425 more in fixed assets. So one more time. If the company bought no assets during 2018, they would have taken the beginning balance of their fixed assets and subtracted the 276 in depreciation expense that they expensed of those. The balance should have been 2455, but it's not, it's 2880. So the difference is the amount of assets they actually bought, which is 425,000. When they buy more fixed assets, that decreases cash. So the impact from investing activities was to use cash, 425. So they provided cash for the business from 691 from their normal operations, and they used 425 of it to buy more investments in fixed assets. The last category is financing activities. And what we account for here is the change in our notes payable, if they're current, long-term debt, and equity. That's cash related. So now we're focused on that part of the balance sheet. So we come on over and we go, okay, our notes payable went from a balance of 231 at the beginning of the year down to 196, or decreased 35,000. So that means we paid off 35,000 or 35 of the notes payable. So that's a decrease to cash. Long-term debt, same situation, went from a balance of 531 the beginning of the year down to 457. So it decreased 74,000. That means we paid the cash. So that the effect of that decrease is a decrease to cash. Now during the year, the company's common stock goes from 500 to 550 because we also report any cash change in our equity accounts here. So we actually brought more cash in. So that means we sold more stock. It's an increase to cash. Now they tell us on the income statement on page 52 that the company paid 145 in dividends. That's part of equity. That means they decreased cash in the financing area because they paid dividends. So now we've accounted for all the changes in our assets and liabilities and equity and shown their impact, depending on what category it belongs in, on cash, on the statement of cash flow. So we subtotal the financing areas, increases and decreases. So overall, the company spent 204 to pay off. Either they were paying off liabilities or they were paying stockholders dividends, but in the financing area. Overall, they brought in 691 from normal operations, so that's positive. They spent 425 to buy more investments, so we subtract that. And then they spent 204 on the financing activities. So overall, their cash increased 62 from beginning of the year to the end of the year. And the way you can prove that is add the 62 to the beginning balance of 84, and that'll give you the ending balance of cash on the balance sheet of 146. So the balance sheet just tells us how cash changed. It went from this amount to this amount. The statement of cash flow tells us the why. Where did the money come from? What were the sources and what were the uses? And you could see down below where the statement of cash flow from a financial statement sense is now broken down into sources and uses. So in that statement, we start with cash at the beginning of the year. Then we go sources of cash from operations. Net income, add back depreciation. So that's a source of cash, 711. From working capital, the increase in accounts payable. That's the only operations area that had an increase in cash or a source of cash. Sources of cash from financing was increasing the common stock. There were no sources of cash from investing. We used cash in that area. The uses of cash in working capital, remember assets and current assets and current liabilities. Accounts receivable was a use because it increased. We collected less money. An increase in inventory means we spent more money. Decrease in notes payable means we paid off the notes payable, so we used that. Decrease in long-term debt, again, we paid that off. We bought more fixed assets, so that's a use of cash. And then we paid cash dividends to our shareholders. So now all the sources of cash were 793, all the uses are 731, and it still comes out to be the same dollar amount. It's just a different approach to showing cash flow. So that's from the example balance sheet and income statement. So you could take a look through that. I'm not going to go through that again. I used the one in your book, but it's a great second example. So you can grab the PowerPoint and match those items up. Try it on your own and see if you could do it. So we begin the chapter with looking at that final financial statement. Now, once we understand the financial statements, what does the balance sheet tell us? What does the income statement tell us? What does the statement of cash flow tell us? Now we could start analyzing them. And we use tools in financial analysis, finance, pretty much like a doctor would use tools to assess a person's health. We use the same kind of tools, or not the same tools, but we use tools to assess the health, the financial health of a company. So one of the items is called a common size balance sheet, and another one is common size income statement. What we do is on a common size balance sheet, and you'll see this on page 55 of your book, is we convert dollar amounts on the balance sheet to percentages. What we do is we take each item, each asset, and we divide it by total assets. We do the same thing with liabilities and equity. Each one of those, divide them by total assets. And what it's telling us is what percentage in the top each asset is of total assets. So cash represents on page 55, 2.5% of all the assets. Accounts receivable amounts to 4.9%. Inventories, 11.7%. Fixed assets are 81%. If we do the same type of calculation for last year, convert to percentages, now we could measure the change in those items, each specific item, as a total of total assets, or as a percentage of total assets. Now we do the same thing with liabilities and owner's equity. We use the total asset amount, but that's the same as total liabilities and equity. So you can look at this from one of two ways. In our example, and this is for Prufrock Corporation, so you can go back to their balance sheet, which is on page 51, and in the accounts payable, they take the 312 for 2017 and divide it by total assets, or also total liabilities and equity, which is the same number, and they get 9.2%. So run through that exercise of seeing where those percentages are coming from. So what it's saying is accounts payable is 9.2% of all assets, or it's 9.2% of all liabilities and equity. You can look at it from one of two ways. Same with notes payable. If we add the current liability percentage and the long-term liability percentage, 31.8% of our assets are financed with debt. 31.8%, the 16.1 plus 15.7. So we still owe on 31.8% of all the assets. We do the same thing for common stock and retained earnings. And that tells us the percentage of assets the owners own or have provided the money for, 68.2%. So it gives us a better standard to compare ourselves to prior years. And you'll see we also compare ourselves to our peers. And then you can measure how much it changed. We do the same thing with the income statement, if you look on page 56. But this time, we divide each percentage or each amount by the sales. So your denominator is always sales, and then your numerator will be the specific item you want to calculate. So if you took cost of goods sold from our income statement on page 52, which is 1344, and divide that by the sales of 2311, 58.2%. Do the same thing with depreciation for us to analyze and compare. So what this is saying is that 58.2% of our expense, cost of goods sold, or I should say, cost of goods sold is 58.2% of our sales. For every $1 of sales, we're spending 58 cents for the inventory that we sold. Earnings before interest and taxes. So meaning of sales after paying our expenses, except for interest and taxes, is 29.9%. 6.1% of our sales goes for interest, 5% goes for taxes. So we retain in the company 18.8%. 6.3% of the other 12.5% of that 18.8 is added to retained earnings and reinvested into the company. When other companies do this, now we could see where we stand because we're comparing percentages. So we do a lot of work with percentages. So we want to make sure you understand how to calculate those. Now, the other major component of our analysis is ratios. So ratios are converting numbers into percentages or numbers, just a number. And they allow for a better comparison through time or between companies. So we want to compare ourselves from year to year to year. We want to compare ourselves to other companies in our industry. As we look at each ratio, we ask ourselves what the ratio is trying to measure and why that information is important. So you know ratios are used internally and externally. Bankers use them, investors use them. It's a common, the people in finance are using them in the department and outside of the department. If they have your financial statements in another company, they're doing ratio analysis on you. So it's a common exercise that we do inside the company about ourselves and those that are looking at our company. We put our financial ratios into one of 5 categories. There's ones for short-term solvency or liquidity. There's long-term solvency, or what we call financial leverage. There's asset management, or what we call turnover. We measure profitability of the company and market value. So we're going to take a look at each one of these. So they're using the balance sheet from that example in the beginning of the thing, and I'm just going to click on it. There we go. So there's our sample balance sheet. Well, what's going to happen when I go? Oh, okay. Let me see if I can go back to last viewed slide, and then last view slide, and the last view slide. There we go. So let's see where these numbers came from. The current ratio is calculated by taking your current asset amount, the total current assets from the balance sheet, and dividing it by current liabilities. So I'm just going to go ahead back to the balance sheet. So current assets are 2168, current liabilities 1995. 2168, 1995. What do we get? 1.09. And they use the word times. Okay, so what this is saying is that for every dollar in current liabilities, the company has $1.09 in current assets to pay it. Or this company could pay their current liabilities 1.09 times with current assets. And that's really important because if you go back to what is a current asset, it's an asset that's available to be used in the coming year. What's a current liability? It's a liability that's due in the coming year. So we're going to use our current assets to satisfy our current liabilities. So we want to see, do we have at least $1? Can we do it at least one time? So that's what it's telling us. Is it good or not? That depends. What are you striving for? What's your past history? What do your peers do in the industry you're in? The quick ratio factors out inventory out of your current assets. So we look at assets that are very liquid in this ratio, those that are almost cash or already cash. So current assets minus inventory. So I'm going to go ahead back. Here's your current assets, 2168. We subtract out the inventory. These other assets are considered very liquid. Your prepaid expenses, your accounts receivable, and your cash. Divide that by current liabilities. So we get 2168 minus the 501 in inventory divided by 1995, and that equals 0.84 times. And the way I like to look at this ratio is if all of your current liabilities became due, would you have enough money in these very liquid assets to pay them? And the answer is no. We only have 84 cents of really liquid assets to pay $1 of current liabilities. So we may want to look at that. I don't know if that's good or bad, but that's what our number is. The next ratio is the cash ratio. How much cash do you have just to pay? How many times can you pay your current liabilities just with cash? So take a look. Your cash balance is 108. Current liabilities are 1995. So 0.05 times. Again, we don't know if it's good or bad at this point. We just know what it's telling us. How many times you could pay your current liabilities with your current cash. The next is net working capital to total assets. So we take our net working capital, which is current assets minus current liabilities, and divide it by total assets. So we're getting 0.03. So it's if your net working capital to total assets ratio is low, you may have a low level of liquidity. So it's saying, here's how much money you have left over in current assets after paying off your current liabilities. What percentage of that is that of all of your assets? You might not be very liquid. You may want to reconsider how much assets you have in this category. Interval measure. This is where we take current assets and we divide them by our average daily spending or operating costs, average daily operating costs. So we go back to our income statement. And those should be our expenses plus our cost of goods sold. Cost of goods sold plus expenses are our daily operating costs. And divide that by 365 days. So it's telling us how much we spend on our daily operations every day. $211.2 per day. Let me do that again. That's not right. I'm looking at it wrong. 2006 plus 1740 equals divided by 365. Actually, we spend $10.26 per day. Okay. Now, we divide that result into our current assets. So this helps us. I'm just reading along here because this is a newer one to me, but this is telling us how long the company can operate until it needs more money, more in current assets. So that's how much in current assets there are to fund our daily activities. If our daily activities cost us $10 and we have $21.68 to use to spend them, then we have about 211 days worth of assets to fund our daily operations. So this is a really good thing, as I mentioned in your book, for startups to see when are we going to need more financing. The next set of ratios are the long-term solvency ratios. They measure how well or how much in long-term debt you have as compared to what you own and how well you can pay your debt. So the first one is total debt ratio. So that's where we take total assets minus total equity, which is your total debt, total liabilities, divided by total assets. So the total debt would be 5606 minus 2768, or if you took 1995 plus 843 from your balance sheet and divide that by total assets. So 50.62% of our assets have debt attached to them, or we owe on 50.62% of our assets. I don't know if that's good or bad. Debt to equity, now we take that total debt again, but now just divide it by equity. 1.03. So there is total debt ratio, debt to equity, 0.38 times. And that is telling us we're just comparing our debt levels to our equity levels. So 5606 minus 2768. So our debt is at 2838. We divide that by 2768. So our debt is 1.03 times more than our equity. The next item is the equity multiplier, which is we take total assets divided by total equity. Okay. And we add it to 1. 2.03. Just give me 1 second. Sorry, I had to. Come on. Okay, sorry about that. I got myself a little jazzed up. But the equity multiplier is just showing how much the the assets, or I'm sorry, the total assets are funded by the total equity, 2.03. There, I got it out. Long-term debt ratio is just focusing on the long-term portion of debt, and it's telling us what portion of our total assets are being financed by long-term debt. No, I'm sorry. What portion of our long-term debt and total equity is what part of long-term debt, gosh, I guess should just start over. It's showing us the percentage long-term debt is of both long-term debt and equity. So it's just giving us different perspectives, different ratios to help determine how well we're financing the company. What kind of solvency do we have? Do we have the ability to pay our debts? I'm going to end our presentation right here. I actually have to go to an appointment. So this was part one of our presentation, and then I will be putting a part two, which is probably another 13 or 14 slides when I return.